On today's Hot Sheet, I'm discussing housing inventory, Q2 home prices, and Ivy Zelman on housing challenges. Today is Monday, July 22nd, 2024. I'm Byron Lazine, and the Hot Sheet starts now. Welcome into the Hot Sheet as we kick off a new week here. It's been very eventful weeks in the news and in the headlines, and real estate's starting to get very eventful too. If you're an agent, you know what I mean. We're leading up within 30 days now to the August 17th date. It's more important than ever that we close the knowledge gap, that we have the knowledge and continue to hone it in each and every single day. It's why we do the Hot Sheet every Monday through Thursday that the markets are open. It's 9:30 on the east, just like it is now, 6:30 on the west. Consider sharing this hot sheet stream with somebody who could benefit from a 24-hour look back on housing. Hit the thumbs up down below, and of course, subscribe to the channel. As we do every kickoff to the week, we're going to jump into inventory. Now, last week, if you were with us, you remember I said we're hoping for a double up on inventory this week. Essentially, what that means is getting back to that like 8, 9, 10,000 a week, but really double that this week. Why? Because last week was the first week we fell flat on inventory in quite some time. It was due to the 4th of July holiday, put a stall in the market, in new listings specifically, which drove down the growth on active listing report. So this week we're hoping for an increase, and we got it. We got inventory growth of just shy of 17,000 new inventory. So active inventory rose about 17,000. That puts us back on pace, to me, to get back to like where we started 2020. We started January 2020 at 763,000. We get this kind of growth to continue here through August. Through September, we could be back in the 750 plus on active inventory across the country. I would expect that number to slightly decline, certainly as we get into election month, November, and holiday month, December, okay, before it starts to have its seasonal uptick after January the 1st, okay? So 750,000 would be an extremely healthy place when you consider, according to Altos research, at the inventory bottom last year was 240,000. The same week last year, we had 480,000 on active inventory as this week. And right now we're sitting here at over 668,000. That's almost 40% more than the same time last year. We've also crossed over at the same point of the year where we were in 2020. 2020 was certainly an odd year, being on the decline at this point, where most years historically were still on the uptick here, middle of summer, middle of July. Okay. You can see here on your chart, well above the 2020 level at this point, but still well behind 2018, 2017 levels and 2019. 2019, I consider fairly normal market, 969,000 versus the 668,000 at this point. So still 300,000 away from what a pre-pandemic normal inventory market looks like, but significantly more than the bottom levels we've seen the last couple of years, and improving. Okay, this week was a big indicator of that. Getting the 17,000 active listing inventory growth this week after the holiday week does basically certify that, hey, last week was the holiday. It was a little blip. Now we're going to get back to active inventory growth. And we did see a pop in new listings. This is according to, again, that Altos research that we look at every single Monday. New listings for the last week were 68,000 versus 62,000 last year, all-time low, of course. 2022, over 80,000. But last week, we saw the first dip in new listings below last year's level, which we don't ever want to see that, because last year's level was the historic low bottom. Okay, so now bouncing back off of that bottom is a good sign that hopefully we're getting to a healthier place on new listings. Our hope here is that that will continue throughout the year. If you look at 2022, it really in a couple of weeks, 2022 started to plummet. And you do see this historically. You see new listings will start to really decline as we get out of July. Any hope here for real inventory growth would be that we'd stay on this flat line of 68,000 where we've been throughout the spring. Historically, that doesn't happen. We'll see where it takes us as we get into the later summer season and the fall. Okay, price cuts. The percentage of properties with price reductions before they sell is historically 1/3, 33%. Right now, we're running at 39%. That's more than this time last year, or in 22, we were riding at 34 and 35%, respectively. 22, you really were on a sharp, rapid increase on price reductions, got as high as 43, almost 43.5% during that year. The peak last year before the seasonal decline was 39% last year. Okay, so we're already at 39% last year, meeting or 39% this year, meeting last year's peak. You would expect that as inventory grows in the late summer and the fall and transactions continue to decline as they historically do, that you'll see this number probably approach 2022 levels of 43%, could even potentially go higher than that. Just that'll really depend to me on where this interest rate goes. Based on demand, what's the demand going to look like? The demand is less than it was last year, and it was less than it was in 22. So where's demand going to be as we accumulate more inventory later in the year? And you naturally will see less transaction. Will demand actually spike if the rates continue to move down? If we get a rate that could be, I made the argument last week, if we have the same reaction leading up to what we believe is going to be a rate cut in September that we had at the end of the year last year when we believed the rate cut was going to come in Q1, could we get below 6.5? Could we get to 6.25? Could we even get into the low sixes on the 30-year fix? If that were to happen, would we see a late season, late year increase in demand? And would that change some of these, that would obviously change price cuts, because if people are getting more traffic on their home and it's like, hey, I'm getting good activity on the weekend, I'm getting good activity during the week, why would I cut my price? Why don't I just wait another week? Why don't then all of a sudden those pendings start to pop if that's the case? Speaking of pending sales, we've got 382,000 pending sales, homes in contract right now, according to Altos. That's only 1% more than were in contract last year. And remember, last year we had 200,000 less homes actively on the market. So this is one of those big examples of where demand is nowhere close to the levels it was last year or in 22. Okay, you've got the same contracts as last year and you got 200,000 more options. Why were we saying buyers were missing out on properties in 21? Well, there wasn't enough inventory. We've got 200,000 more homes than last year, yet we have the same amount of homes under contract. This really speaks to how much true demand can afford a property during these current conditions. 2022 was 418,000 under contract, well above the level of that we're currently seeing or last year. And we've really been riding the same line almost as last year. It's been a little bit higher during the peak spring season, but that gap has really tightened up here as of late. It'll be interesting to see where that goes. Obviously, we're on a seasonal decline in pending home sales going through the rest of the year. Real estate agent community is obviously about to go through a whole bunch of changes. So those two things taking effect all at the same time. Okay, here's speaking more to that demand mortgage purchase application index. At every single point this year, we've been below the 2023 levels for mortgage demand and well below 2022 levels. That won't spike until we see a decrease, obviously, in the 30-year fix. The spread between the 30-year and the 10-year treasury have been improving. Okay, so we're getting, and that's one of the drivers right now, along with this belief the Fed's going to have this rate cut. This has been one of the drivers for a lower 30-year fixed lately is the spread has been dramatically improving back, not back to historic norms, but getting closer as we move each and every single week. If we took the worst levels of the spread from 2023 and incorporated those today, mortgage rates would be 0.52% higher right now. Okay, so if we look at where the spread at the worst was last year, we'd be back up over 7. We'd be at that 7.35 level that we were just at about 45 days ago. So this is a huge improvement for this year, and it's keeping us right now, obviously, under 7%. We ended last week at the 6.89 level. That was up a little bit from where we were during the rest of the week. The Freddie Mac 30-year fixed weekly came in at 6.77. That's the lowest level we've seen in weeks on the weekly survey. So this number would be, closer to 7.4 right now if we had last year's spread. So the improvement on the 10-year, 30-year spread is helping 30-year fixed rates quite a bit. Okay, home prices have been helped a lot this year, and just based on the fact that sellers are holding the strong hands. We went over that article recently, the strong hands, the diamond hands for all of those crypto investors. Home prices rose 6.9% year over year in quarter two. It is down from 7.3% in quarter one. And I would expect each quarter you will see a softening in these year over year prices. Okay, as we've seen, the demand not be as strong as you would expect with an increase in inventory, and this is due to the affordability. So home prices grew 6.9% year over year in the second quarter. This is a Fannie Mae report for the entire second quarter. And you see this little nudge down right here showing an indication that year over year percent from 7.3, 6.9, it's starting to cool off again. Okay. Now, if you look at the HPI over time, that light blue line, what are home prices going to do in the future? They're going to do what they've done. I don't know, the last 50 years, the last 4+ decades, they're going to go up and to the right. And so if you're a long-term holder of real estate, if you're advising a buyer, that's what you really would like to focus on is, okay, what is the reality of how long you're going to be in this home? What's the reality of what prices are likely to do? The last 50 years would tell us they're going to continue to go up. Doug Duncan, Fannie Mae chief economist, says home prices rose again in the second quarter, but the pace of growth slowed. Okay, as important elements of housing demand and supply inch closer together, elevated mortgage rates and ongoing affordability constraints are increasingly limiting homebuyer demand and thus dampening the pace of home price appreciation. Meanwhile, the number of homes available for sale is rising in many metro areas. That's going to dampen home price growth as well. So while we expect home price growth to decelerate further in the coming quarters, home price growth decelerating is not homes values dropping. Okay, that's the actual appreciation decelerating, not home prices dropping. Still tight inventory for sale, stretched affordability remains significant challenges. And then we have a constraint mortgage demand and home sales for foreseeable future, according to Doug Duncan from Fannie Mae. Now, there are certain markets where you have such an extreme elevated level of inventory that you might actually see home prices not only home price growth decelerate, but that you might actually see home prices go down. Okay, there's going to be certain pockets of the country where you could make that case. But when Doug Duncan, Fannie Mae chief economist, is looking at the whole pie, all of America, it's not the case where you've got this rapid increase of inventory everywhere. Okay, it's really small certain pockets. Okay. So there you go. Supply and demand are driving the market as they always do. And the elevated rates and affordability constraints are limiting this home buyer demand while the number of homes for sale is increasing. And that's going to ultimately continue through the rest of the year to slow this home price appreciation. You can get more on Fannie Mae's latest home price index with the links inside of BAMX. Every single day that we do the hot sheet, we release these hot sheet show notes. So many of you guys, BAMX members, are writing in that you are using these hot sheet show notes in your text messaging, in your CRM database, one-on-one follow-up, or in email blasts and things of the like. You can gain access to this, all of our courses, as well as all of the charts that we share here inside of BAMX, as well as the community and our live streams. Use code HOT to get discount on BAMX and gain access to everything going on in the BAMX community. Okay, recently, Ivy Zelman put out a podcast with Willie Walker, and she talked about the housing challenges and some predictions. Ivy Zelman was one of the only, you'll hear now on X and other places, people that'll look backwards and say, and Willie Walker's from Walker and Dunlop, by the way. If you thought that was a cartoon character, that is not. It's from Walker and Dunlop. Anyways, you'll hear people on X saying, hey, I was predicting the housing crash, in 2004, in 2005. Listen, I bought 3 homes, 2004, 2005, 2006. I went bankrupt in real estate by December 31st, 2008, by being a 19-year-old idiot, making every single mistake in the book as we led up to the great financial crisis. When I see people today saying, oh, they predicted the housing crash during those years, it's laughable. They're liars. The over 99.99% of belief at that time was real estate's never going to go down. It's running up to, crazy out of reach price. Buy real estate now or you're never going to be able to buy it. The money was obviously so accessible. You didn't have to even have income. You can get these loans. Just watch the movie The Big Short, as I'm sure you have, and you understand, right? And so really one of the only 2 or 3 true analysts that said during that time, we're about to go through the biggest housing crash of our lifetimes, we're going to have an economic meltdown, was Ivy Zelman. You can go and find records of her saying this. Some of these other clowns, you can't find any record of them. She put information out there. She said it on news outlets, mainstream media outlets, and she even documented and wrote about it. So Ivy Zelman, when she speaks, I listen, okay? Housing affordability, the current state, according to Ivy, rising interest, home prices, along with other costs like homeowners insurance, are making it difficult for prospective home buyers, okay? I want to go to some of her clips here. If we've got those lined up. Haley, do we have those lined up? Yeah. We'll have those lined up here in a second. We'll go to some of the clips. We'll watch some of her commentary during this podcast with Waller and Dunlop. Waller and Dunlop is another analyst firm. About the high-end market, she says that the high-end market remains relatively strong, okay? Despite challenges, Ivy's opinion here is the high-end market has been relatively strong. She talks about the lock-in effect. We'll get to that. Affordability for renters versus homeowners. It's 30% more affordable to rent an apartment than to buy a home currently. That's going to obviously restrict this home buyer demand. But if you go to the 8-minute 43-second mark in the pod, I think this is an interesting comment here from Ivy Zelman. Let's go to that.
You mentioned affordability. It's incredibly challenging for today's prospective buyers, not only with the monthly payment, with rates rising as much as they have, but home prices having continued to rise north of 5-6%, and even wage growth, although trying to keep up. We have other factors like homeowners insurance, which is soaring, and other incremental costs that are also weighing on consumers' ability to buy. So I think it's tough for people. And one of the things we saw during this higher rate environment is record cash purchases. So there's more challenge, as you'd expect, at the lower end of the price spectrum. And the more fluent higher end is still doing relatively well, but there's a lot of sellers that we call it, they have aspirational pricing. They want the pricing, the peak pricing from COVID. So there's holdouts, but I do think that there's the spectrum of where the healthiness of the market is the strongest is really at the high end.
So there's Ivy's comment that I wanted to go to. I don't know if everybody can hear that background noise or not, but We got some background noise going on. I apologize for that if you can hear it. Let me know in the comments if that's super annoying. We can cut the stream short, and I can go to some of the Zelman stuff tomorrow if we have to. Walker and Dunlop. This is a webcast. It was a webinar. It wasn't a podcast. It wasn't a webinar. It was something in between, some kind of webcast. But Walker and Dunlop, 85 years they've been analyzing the market. They've also, their main bread and butter, just so everyone understands, is commercial financing. Okay, so commercial real estate market financing. She has some comments on affordability, renters versus homeowners. If you actually go to the 1225 mark, we'll get Willie Walker's lead up, and then at 313, Zelman will respond. So affordability for renters versus homeowners. Willie Walker starting with a slide, and then we'll get Ivy Zelman's response.
And one of the slides that jumped out at me, Ivy, as you're talking about differences between rental and home ownership, was you're tracking on rent growth. And it's an amazing slide that shows where the CPI is tracking rent growth. And it's this red line that's way, way up. And then you all track 7 other indicators of rental growth, and they're all dramatically below them. And you see this big lag in where CPI rent growth goes versus where all of the other indicators are. I don't want to dive too much into the rabbit hole as it relates to why CPI is still giving us these sort of false prints on rental. But I thought that data point, I mean, if you took that slide and like sent it to Jerome Powell and just sort of said, the data you're pulling out on your rent growth is way off of what we're pulling out of actual market sources, is really quite something.
Yeah, and it's frustrating to many market participants, given that the measure that they're really focused on is the owner rent equivalent. So OER is really the basis of how they're determining CPI, which is 40% of shelter, as opposed to actual rents. They're sampling households, et cetera, but it's not the same data that we have, which is actual rents, right? So we're looking at not only new move-in rent rates, but blended rent rates that are showing that the deceleration, really overall, rent growth has normalized for the most part, and we don't expect much more pressure. In fact, the spring selling season in the last quarter especially showed that rents were actually stable to moving back up a little bit, which we think might be temporary just because the supply that still needs to be delivered could pressure rents in the back half of 24. But, the CPI is no question very much lagging. And I think Jerome Powell knows that. So I don't know. There's a lot of OER that, people say people don't move a lot. So their rents don't change very often. So you have to take that into consideration when turnover is pretty.
And I think Jerome Powell knows that is the headline there. I actually don't think he knows that, but you know why, if you've been following the hot sheet, you know why I wanted to play that clip so much, because it's exactly what I've been saying for over a year and a half now on the hot sheet, is exactly what Ivy Zelman just said. Owner's equivalent rent. I mean, I say it a lot less smarter than she does, a lot less sophisticated than she does. I say owner's equivalent rent is trash. It's a garbage metric. It's a stupid, made-up survey, and we're asking people to chime in on this survey that drives near 40% of CPI. Ivy Zelman was rounding up there, of course, but we're asking people who have no idea about the rental market. They're not property managers. They're not, investors in the rental market, what they think their households would rent for if they were to rent it. This isn't actual rent. She says, but it's not the same data that we have, meaning like people that just look at the data, apartments.com, CoStar, Zelman and Associates, or even, Walker and Dunlop, who is lending. They're doing commercial lending. Do you think they're not going to look at the actual data, what's actually driving rents right now? And she goes on to say that rent growth has normalized for the most part. There's actually real-time data we covered last week where it showed it's declining month over month. Okay, so if the Fed would take that into consideration, the CPI would be a lot lower than what it's actually showing, because shelter is still driving. And Jerome Powell has said in the past, we're not going to see that lagging, the lagging data reflect what we're seeing here in real time for maybe up to a year from now. So very disappointed there. Inflation in the luxury market at the 2044 mark, Haley, and all these, there's more out of this with timestamps that are relative to what we talk about here on the hot sheet. You can jump into your hot sheet show notes on BAMX. Of course, use code HOT to get into BAMX if you're not in there already. And you can grab all these timestamps and use this for your market and whatever's relative to your market and updating people on relative information about where we're at. So asked about the luxury market. Zelman's response is this.
Price.
No, it's been a rocket ship. I mean, we've seen a tremendous spike in homes purchased that are valued over $1 million. And it makes sense given the fact that we have had so much home price appreciation. I mean, I could tell you a home in Naples, Florida that might have sold for $500,000 is now well north of $1 million. So a lot of homes have doubled in value and even tripled in value in certain, coastal markets. So there's no question that, there's the inflation at the high end has just surpassed any expectations we would have had. So it's more than doubled, if not in some cases tripled.
Yeah.
And
every market, go ahead, you can stop that. Every market in across the country has got a different definition of obviously what luxury would be for that market, right? You could argue, she brought up Naples. I'm very familiar with Naples. Obviously, I have a house there. Naples would be, 500,000 now to $1 million. That wouldn't even be considered luxury for that market, $1 million. But it might be, $1 million home might be very much a luxury market. For another town, certainly the town that I'm sitting right here, small little coastal town in Connecticut, that $1 million would be considered luxury here in this particular town in Connecticut. Okay, so it really depends on where you're at, and the definition of luxury has certainly grown in most markets. Okay, let's go to. Do I want to do the building one? Let's do the public versus private builders. She has some commentary on home builders. Obviously, home builders, months of inventory, much different than existing home sellers. So it's important that we understand kind of the builder market. We cover it a lot here. And this is Ivy Zelman's thoughts on public versus private builders right now.
Well, to put some context around it, when I started covering the industry in the early 90s, the market share for the public home builders was south of 10%. And today it's north of 50%. Yeah. So it's been a very strong growth story over time. In fact, when you look at Horton and Lennar alone, they account for 30% of new home sales. So they're head and shoulders above the other public builders. But when you think about why, well, the cost of capital is anywhere from 500 to 1,000 basis points lower for the publics. They have scale advantages, whether it's buying raw materials or they're dealing with bulk deals.
I mean, there you go. She's talking about publicly traded builders that really have dominated the market now versus private builders, or almost essentially, pushing the private builders out of the market. Update here as we go into the week on the 10-year. There it is, 4.22 on the 10-year. It's kind of where we've been hovering, a little bit below here for the better part of 5 days. Could see some uncertainty in the market today. What is the stock market doing right now? Stock market is essentially flat on the Dow from where we were Friday. NASDAQ's up a little bit. Could have imagined some uncertainty with all the historical major announcements day after day after day. And I don't know if we've run out of historical major developments across the country, but of course, another big weekend. So it'll be interesting to see what happens this week. We'll cover it all for you here on the Hot Sheet, live every single Monday through Thursday, 9:30 on the East, 6:30 on the West. If you like what we're doing here on the Hot Sheet and like what we're doing at BAM, check out bammania.com to grab your tickets for our big event in October. I'll see you guys back here tomorrow. Until then, toodaloo.